Hey everyone, and welcome. Today, we're pulling back the curtain on the world of insurance. Now, I know it might not sound like the most exciting topic, but trust me, it's one of the most powerful and fascinating business models on the entire planet. And it all kicks off with one simple question that's actually kind of confusing.
I mean, really think about it for a second. This is a company whose whole job is to pay out enormous sums of money when things go terribly wrong. We're talking accidents, illnesses, you name it. So, how on earth does a business like that not only stay afloat, but actually become incredibly profitable? Well, the answer lies in what you could almost call financial alchemy. It's a system designed to generate these massive pools of cash that can then be put to work. And understanding this is the key to the entire industry. So, yeah, let's peek behind that curtain.
Okay, so first things first, what is this product really? Insurance isn't something you can see or touch, which makes it a really unique and kind of tricky thing to sell. At its core, that's all it is. Whether it's for your car, your health, your life, you're basically paying a small, regular fee to protect yourself from a potentially massive, life-altering cost down the road. It's a safety net.
But here's the puzzle, right? We all kind of know insurance is a smart thing to have. It's the responsible choice. And yet, a whole lot of us put it off, we delay it, or we just never get around to it. So, what's up with that? Well, the reasons are, very human. For a lot of people, it's about the cost or just not really understanding all the options out there. For others, it's just not an urgent problem. It's a, I'll deal with it someday kind of thing. And then, of course, there are those deeper psychological walls. I mean, nobody really loves to sit down and talk about the worst case scenarios, right? And this is not a small issue. To get a sense of the scale of this, just look at this number. A staggering 83% of working millennials in India, that is a massive chunk of the population, don't have any life insurance. But here's how the industry sees it. That's not a failure. That's a colossal opportunity. That 83% represents a market that could potentially grow by 5 times. If these companies can just figure out how to crack that nut, the potential for growth is absolutely enormous. Okay, so we know there's this huge, untapped market out there, but how do these companies actually turn that into cold, hard cash? Let's break down the money machine. It's really this brilliant two-part process. The first part is what you'd expect, underwriting profit. The goal is to collect more money in premiums than you pay out in claims. But here's the big secret. A lot of companies don't even make money this way. The real magic, the real genius, is in part two, the investment gains. And this brings us to the industry's secret weapon. It's a concept called float. The float is all that premium money that insurers collect from all of us. It just sits there in this giant pool waiting for claims to eventually be paid out. And here's the kicker. While it's sitting there, they get to invest that massive pile of money for their own profit. It's basically an interest-free loan from millions and millions of customers. And if you want to know just how powerful this is, look no further than Warren Buffett. At its heart, his company, Berkshire Hathaway, is an insurance behemoth. He masterfully used the power of float to build one of the biggest investment empires in modern history. All right, now you have to understand that not all insurance is created equal. The industry is really split into two very different worlds, and knowing this difference is key to understanding how they operate. So on one side, you've got life insurance. This is the long game. Policies can last for decades, which means the company has that money for a very, very long time. That allows them to invest their float in things like stocks, assets that have higher risk, but also higher potential returns. Then you have general insurance, think car, health, home insurance. That's a short-term game, usually under a year. That money could be needed at any moment for a claim, so their investments have to be way safer, way more conservative. So you've got this invisible product and this really complex financial engine behind it. How in the world do insurance companies actually get us to buy it? Well, it all comes down to the art of the sell. They use a whole bunch of different channels. We all think of the classic insurance agent, and they're still around, for sure. But the biggest channel by far is something called bancassurance. That's just selling insurance through banks to their huge base of existing customers. After that, you've got group plans through your job, direct sales, and of course, a growing digital push. Let's talk about that digital world for a second. We've all seen this, right? You're booking a flight, you're on that final checkout page, and there it is, that little checkbox, add travel insurance for just a tiny amount. It's a total impulse buy. And really, it's the financial version of the candy bars and magazines right next to the cashier at the grocery store. You weren't planning on buying it, you don't really think about it, the cost is so small you barely notice, so you just toss it in the cart. It is a brilliant, high-volume way to rack up premiums. But let's not forget, the entire business of insurance is about taking on risk. Huge, unpredictable risk. So how do these companies manage this massive financial beast without the whole thing just blowing up in their faces? The name of the game is diversification. They spread their risk across different places so a hurricane in one region doesn't wipe them out. They ensure a mix of age groups with different risk levels. They spread their investments across different types of assets. And they very carefully manage when all their potential payouts might come due. But what happens when the unthinkable hits? I'm talking about a catastrophe so massive, so widespread that all those normal diversification strategies just aren't enough to handle it. Well, that is where reinsurance comes in. This is the ultimate safety net. It is literally insurance for insurance companies. They pay a fee to another, even bigger company to take on a chunk of their most extreme risks. It protects them from a loss so catastrophic, it could sink the entire company. So let's wrap this up. What are the big things to remember? 1. There's a massive untapped market out there. 2. The real profit comes from a 1-2 punch of underwriting and, most importantly, investing the float. 3. The industry is split between the long game of life insurance and the short game of general insurance. And finally, they control all this risk using diversification and their ultimate backstop, reinsurance. Which leaves us with one last question to think about. We usually see insurance as just a simple safety net for our own lives. But when you really look under the hood at the incredible power of float, the flow of all that money, this global system for managing risk, you have to wonder, is insurance just a safety net, or is it actually one of the most powerful financial machines ever built?